I'm going to show you how to save your money strategically. That way you can continue growing your wealth despite the inflation happening. So let's break it all down. Every time you save money, it has to be done with a purpose. And there are 3 reasons why you should be saving money. Number 1 is you want to save money for an emergency. Number 2 is you want to save money for a big purchase. And number 3, you should save money for an investment. And this should be done in different bank accounts because you don't want to commingle these things. We're not talking about saving money for an emergency. What every financially savvy person does is they have a separate account called a rainy day fund, an emergency fund, call it whatever you want, where it's extra cash to protect you in case something bad happens, in case something happens to your house, something happens to your car, you lose your job, something happens with your family, gets sick. You have this extra cash to protect you so you don't have to worry about how you're going to pay this expensive bill. The amount of money you need to have in this emergency fund will be somewhere between 3 to 12 months, depending on where you are in your financial journey. And when I say 3 to 12 months, I mean 3 to 12 months of your expenses. So if you spend $5,000 a month, well, take the $5,000, multiply it by 3, which is $15,000. Take the $5,000, multiply it by 12, which is $60,000. And that's the range of how much cash you need to have to protect you against an emergency. So you figure out how much your monthly expenses are, multiply it by 3, multiply it by 12. That's how much money you want to have in this emergency fund. And the amount of money you're going to save is, again, going to depend on where you are, because if you're 23 years old, you're just starting your financial career, you don't need 12 months worth of emergency expenses because you probably don't have a lot of responsibilities financially. But if you're 45, you got kids that you got to take care of, you got parents you got to take care of, and you have a whole bunch of other financial responsibilities, maybe you won't feel so comfortable with 3 months of savings put aside. Maybe you need 6 or 9 or 12 months of savings there to protect you. But beyond 12 months, that's enough. You don't need more than 12 months, because if you were to lose your job and a lot of bad things happen, you can continue living your life for a year to get back on your feet financially and not have to worry about a thing. So 12 months worth of expenses max. And this emergency money, again, is not there to make you wealthy. This is there to protect you against an emergency. This money can be stored somewhere here, and ideally someplace where you're going to get at least some sort of interest. I mean, a high-yield savings account is great. A treasury can be great. These are places where now you can generate at least some interest. Again, you're not trying to become wealthy, but you can generate some interest. That way the money is at least doing something instead of just sitting there flat. Now you might be wondering, well, Jaspreet, why don't I just take this emergency money and put it into the stock market? And the reason why is because, well, the stock market goes up and down. And now if a bad thing happens, like you lose your job during a recession and the stock market has fallen by 50%, well, now your savings have also been cut in half. That's why these savings need to be put somewhere safer, where they're not going to be growing very aggressively because it's low risk. That way you can keep the value of those savings, even though you might not be beating inflation. Then, when it comes to saving money for a big purchase, maybe you want to buy a car, you want to buy a house, you want to buy a watch, whatever it is, you want to have a separate account to control and own that money. Now, this money is going to sit there for whatever you want to purchase. And again, use one of these cash accounts to save this money if you don't want to see the value of that fall. Then when it comes to saving money for an investment, what I do is I have separate accounts for my investment cash that's waiting to be invested. And what I mean by that is I invest my money into stocks, I invest my money into real estate, I invest my money into startups, and I have different bank accounts that are holding the cash that is going to be invested for each one of those things. And when I have that cash sitting there, it is sitting in an account generating interest. Things like high yield savings accounts that are generating some interest while it's waiting for an investment opportunity. Now, this doesn't mean that I'm waiting to invest all of my money. I'll talk about my investing strategy in just a minute. But the cash that's waiting to be invested, that is earning some interest as I'm waiting for a good opportunity for this cash to be deployed, my money that's going to be put into an investment. So keeping this in different bank accounts is one of the easiest ways to organize your finances. I know it can be weird having so many different bank accounts, but I have found that to be the simplest way to organize the money. And no, you don't need millions of dollars to justify having different bank accounts. Even if you have $100 or a couple $1,000s in the different bank accounts, it'll keep your finances organized, and now you know where your money is for each purpose, and then you can allocate this extra cash in the right place. Now, once you've done this, what do you do with the other cash that you actually wanted to become wealthy with? Now, a minute ago, I was talking about how I have money put aside that's waiting to be invested in the stock market. But that's not the only way that I invest in the stock market. And what I mean by that is, in general, there are 2 strategies that I like to follow when I invest my money. And I can't tell you what to do. I don't recommend what I do to anybody else because I'm not a financial advisor. I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and ever blindly trust a random guy on YouTube. But the two strategies to invest your money are being an active investor or passive investor. An active investor is when you want to manage your own portfolio and find the investments that you want to do. So for example, in the stock market, this would be investing in individual companies. You want to invest in Amazon or Nvidia. That is what active investing is. Passive investing is when you have an automatic contribution or money being invested into your funds that are being managed by somebody else. So there are funds out there like mutual funds and index funds and ETFs, all different types of funds where now instead of investing in one company like Amazon or McDonald's, you're investing into a basket of companies. It might be dozens of companies, it could be hundreds of companies, it could even be thousands of companies. That way now it is managed by that manager and you don't have to worry about a thing. And I'll just give you a couple examples. VTI is an ETF, again, a fund that you can invest in on the stock market that will give you exposure to the total stock market. So if you just wanted to invest your money in the markets, well, VTI will give you exposure to the 2,000 some stocks in the stock market. If you wanted to get a little bit more niche and you wanted to invest in, say, the S&P 500, which is a group of the 500 largest companies in the stock market, there are funds that will give you exposure to that. For example, SPY, SPY. This will give you exposure to the 500 largest companies in the stock market. Now, Amazon is part of that S&P 500. So if you wanted to invest in the S&P 500 and you bought SPY, you would also own some Amazon. And if Amazon started to do really bad and they were no longer a large company, well, you wouldn't have to do anything because then SPY would kick Amazon out and replace it with a different company, so it's passive for you. If you wanted to get a little bit more niche, then we have QQQ. QQQ gives you exposure to the NASDAQ 100. That is the largest 100 companies in the stock market that are not financial. So when you have those 100 largest companies that are not financial, those are generally tech companies, so a lot more tech heavy, more growth potential, but also more volatility. So when you see market crashes happen, generally QQQ goes down even further. But because there's so much money flowing into tech, it creates more upside potential. More risk, more volatility, but also more upside potential. The way you win as a passive investor is just to keep consistently investing your money every week, every 2 weeks, or every month, and you create a system where you set it and forget it. I call it ABB. Always be buying. When you have that type of system as a passive investor, it has been proven over the last number of decades and century that it works to build wealth. As an active investor, again, this is where the cash is being put aside until you find a good investment opportunity. And while the cash is waiting, I like to generate a little bit of interest on the cash. That way, well, at least it's not sitting there doing nothing. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.